Reaching your first $10,000 in savings or investments is often the hardest financial milestone you will ever achieve. But the moment you cross that threshold, the mechanics of wealth building shift dramatically in your favor. When you are just starting out, every dollar feels incredibly heavy and difficult to accumulate, requiring immense discipline and sacrifice just to see your account balance grow by a few $100s. However, once your portfolio hits that magic 5-figure mark, compound interest and investment returns begin to do the heavy lifting, effectively turning your money into a secondary employee that works for you 24 hours a day. This transition is not just about the numbers in your bank account. It represents a psychological breakthrough where the barrier to entry for higher yield opportunities, better investment platforms, and leverage becomes entirely accessible. In today's video, we are going to explore exactly why the first $10,000 is the hardest, how this threshold unlocks new financial tools for both beginners and seasoned investors, and the exact strategies you need to use to accelerate your path to this life-changing milestone. Part 1. The psychological shift of the first $10,000. The journey to your first $10,000 is as much a mental battle as it is a financial one. When you are starting from zero, every small contribution feels insignificant, and the gap between where you are and where you want to be can feel incredibly vast. Many people abandon their savings goals early on because they do not see immediate, life-changing results from their sacrifices. Overcoming this requires reframing your mindset from viewing money as a means of immediate gratification to viewing it as a long-term tool for financial freedom. By focusing on consistency rather than the total amount, you train your brain to prioritize the habit of saving over the size of the initial sacrifice. This shift in perspective is crucial because it turns a daunting mountain into manageable daily or monthly habits, preventing the burnout that usually happens before the momentum even begins. Once you cross that $10,000 threshold, the way you perceive your net worth changes fundamentally. It is no longer just a number on a screen. It becomes tangible proof that you possess the discipline required to build wealth. This psychological milestone releases the scarcity mindset that often traps beginners. Instead of constantly worrying about unexpected expenses wiping out your entire safety net, you begin to see opportunities rather than obstacles. The fear of financial ruin diminishes, giving you the mental clarity needed to make rational, long-term investment decisions. You start identifying as an investor rather than just a wage earner, which aligns your daily choices with wealth-building behaviors. This shift empowers you to look past short-term market volatility and focus on the bigger picture, allowing your portfolio to grow without emotional interference. Implementing this psychological shift requires practical steps that you can take immediately to train your mind for future growth. First, break down your ultimate milestone into micro-goals, celebrating each small increment as a victory to keep your motivation high. Next, automate your savings and investments so that the money is moved out of sight before you can mentally negotiate the trade-off between spending and saving. Additionally, practice detaching your self-worth from the monetary value of your portfolio, understanding that wealth is a process and not a destination. By establishing these mental boundaries, you prepare your mind for the exponential growth that happens when your money starts working for you. You become resilient to market swings and confident in your financial trajectory, ensuring that reaching $10,000 is not just a one-time achievement, but a permanent upgrade in your financial mindset. Part 2. How compound interest accelerates your wealth after this threshold. When you cross the $10,000 mark, the mathematical reality of compound interest begins to work in your favor much more visibly than when you were starting from scratch. To understand the shift, consider what happens when a modest portfolio earns a standard historical market return. If your portfolio grows at an average annual rate of 8%, Your initial $10,000 generates $800 in the very first year without you lifting a finger. This means that your money is effectively earning more than $60 every single month on autopilot. While this amount might not seem life-changing at first glance, it serves as the foundation for the exponential curve that defines true wealth building. The interest you earn starts earning its own interest, creating a compounding loop that gradually reduces the reliance on your active income to grow your wealth. This compounding effect becomes a true game changer as the gap between your personal contributions and the market returns widens over time. In the early stages of investing, the growth of your portfolio is primarily driven by the money you deposit from your paycheck rather than the growth of the investments themselves. However, once you surpass this threshold, the amount generated by your investments begins to equal or exceed the amount you can reasonably save from your active income each month. If you continue to contribute your usual savings while your portfolio is generating thousands of dollars a year in returns, your wealth accumulates at a much faster, self-sustaining pace. This is the moment where the financial machine takes over, and the effort required to double your money decreases significantly due to the sheer size of your principal balance. To harness this acceleration effectively, you need to ensure that all dividends, interest, and capital gains are automatically reinvested into your portfolio rather than being siphoned off for discretionary spending. Leaving your returns inside the investment vehicle allows the compounding engine to run without interruption, maximizing the power of exponential growth over a 5, 10, or 20-year horizon. Furthermore, choosing low-cost index funds or dividend growth stocks ensures that fees and poor performance do not erode the compounding effect, allowing your capital to compound at its maximum potential rate. By understanding this mathematical progression, you shift from being a laborer who trades time for money to an investor whose money works continuously to generate greater returns, making every dollar you save after this point far more powerful than the dollars that came before it. Part 3. Accessing better investment platforms and higher yield opportunities. Crossing the $10,000 threshold opens up a new tier of financial products and platforms that are often closed to smaller accounts. Many premium brokerages and high-yield savings institutions require a minimum balance of $10,000 or more to waive maintenance fees or to unlock their most competitive interest rates. By reaching this milestone, you gain access to institutional-grade tools, such as lower expense ratios on exchange-traded funds and mutual funds, which significantly reduces the drag of fees on your long-term returns. This transition allows you to diversify your portfolio across a broader spectrum of asset classes, including dividend growth portfolios and fixed-income securities that demand a higher entry barrier, protecting your capital while generating steady cash flow. Beyond traditional brokerages, having a larger account balance enables you to explore alternative high-yield opportunities that require larger capital commitments. For instance, many specialized high-yield savings accounts, certificates of deposit, and money market funds offer tiered interest rates that pay significantly higher yields to balances above the $10,000 mark. Intermediate and advanced investors can also start utilizing their portfolios to access low-interest margin or use the capital to secure better terms on various financial instruments. Although this requires careful risk management, having this capital sitting in high-yield vehicles ensures that even your short-term cash reserves are beating inflation while waiting for strategic buying opportunities in the market. To take advantage of these new opportunities, you must actively evaluate and upgrade your current financial infrastructure. Research brokerages and financial institutions that offer premium tiers, reduced transaction costs, or higher annual percentage yields for accounts holding $10,000 or more. It is essential to consolidate your accounts if necessary, moving away from high-fee traditional banks and into modern, low-cost digital brokerages or specialized banking apps that reward larger balances. By systematically transferring your assets to these optimized platforms, you ensure that every dollar works harder, minimizing unnecessary expenses and positioning your wealth to capture the highest possible returns in the financial market. Part 4. The power of emergency funds and risk management. Reaching the $10,000 mark often coincides with a crucial shift in how you manage personal financial risks. Before this point, a sudden job loss or medical emergency can completely derail your investment journey, forcing you to sell off assets at a loss. However, when you deliberately separate your investment portfolio from a robust emergency fund containing 3 to 6 months of living expenses, you create an impenetrable shield around your wealth. This separation ensures that market downturns or personal emergencies do not force you into poor financial decisions, allowing your long-term investments to remain untouched and continue compounding. Risk management at this level is not just about avoiding losses. It is about establishing the structural integrity of your overall financial system so that you can weather any economic storm without panic. For intermediate and advanced investors, risk management takes on a more sophisticated role once your capital base expands. With $10,000 or more invested, asset allocation becomes highly critical to preserve your purchasing power while generating growth. You are no longer relying on a single stock or a concentrated position, but rather diversifying across index funds, fixed income assets, and perhaps a small allocation to alternative investments. This diversification acts as a shock absorber during periods of high market volatility, preventing a single sector downturn from wiping out your progress. By keeping a portion of your capital in liquid, risk-free instruments such as treasury bills or high-yield savings, you maintain the flexibility to capitalize on market corrections without taking on excessive leverage or uncalculated risks. Implementing this level of risk management requires a disciplined approach to asset separation and ongoing portfolio review. You should calculate your exact monthly expenses and allocate a dedicated portion of your capital to a high-yield account that remains strictly off limits for investing. This dedicated liquidity pool should be regularly reviewed and adjusted as your cost of living or income changes over time. Simultaneously, evaluate your investment portfolio for concentration risk, ensuring that no single asset class or individual stock makes up an uncomfortable percentage of your total net worth. By institutionalizing these risk management practices, you protect the $10,000 milestone from unforeseen setbacks, turning your wealth building journey into a stable and predictable process. Part 5. Actionable strategies to reach and surpass this milestone faster. Accelerating your journey toward the $10,000 mark requires a deliberate combination of increasing your income and optimizing your cash flow. One of the most effective methods to achieve this is to implement a dedicated savings-first budgeting system, where a predetermined percentage of every paycheck is automatically transferred into your investment account before you have the chance to spend it. This approach removes the emotional friction associated with saving and forces you to adapt your lifestyle to the remaining income, effectively living below your means without feeling the continuous pain of deprivation. You can also explore leveraging side hustles or freelance work to direct entirely separate income streams straight to your investment portfolios, cutting the time required to hit the milestone in half. For intermediate and advanced investors, surpassing this threshold means maximizing the tax advantages provided by retirement and investment accounts. Utilizing vehicles like a traditional or Roth IRA or an employer-sponsored 401k allows your money to grow tax-deferred or even tax-free, which drastically reduces the drag on your compound growth over the long run. By contributing to these accounts, you not only build your wealth, but also lower your taxable income, providing more liquidity that can be funneled back into the market. It is important to align your asset allocation with your risk tolerance, ensuring that as your portfolio grows, you rebalance your holdings periodically to maintain the optimal mix of growth assets and stable reserves. Achieving and surpassing this milestone also requires a strict review of the fees you pay on your investments and banking services. High management expense ratios charged by actively managed funds can eat up a significant portion of your returns over time, which is why transitioning to low-cost index funds or exchange-traded funds is a necessary strategic move. You should audit your financial accounts at least once a quarter to eliminate any hidden fees, unnecessary subscription services, and redundant financial products that drain your capital. By streamlining your financial ecosystem, you ensure that every dollar is highly optimized for growth, creating a powerful momentum that propels your net worth well beyond the initial $10,000 threshold. Reaching that first $10,000 is not just a financial milestone. It is the moment your relationship with money fundamentally changes and starts working in your favor. By transforming your mindset, letting compound interest accelerate your growth, utilizing premium platforms, managing your risks, and optimizing your cash flow, you have built the ultimate foundation for lasting wealth. The journey requires patience and discipline, but once you cross this threshold, the momentum is entirely on your side. If you found this video helpful and want to continue learning how to grow your wealth, make sure to subscribe to the channel for more insights. Leave a comment below with the phrase, "My first 10,000 is just the beginning," to let me know you are committed to your financial freedom.